video, we're going to discuss debit spreads. I'm going to explain how they work. So let's go over here and look. We'll use, for the sake of this video, Rocket Mortgage. I'm not saying to buy this, and I'm not saying it's a buy, but we'll just use this with a scenario. Let's say it is low. Rocket Mortgage is low. I could buy equity or I could trade options. What would a new person do? A new person would be like, let me see. We're going to cut interest rates soon. I'll choose 2 weeks out and throw my entire portfolio in calls. And let's say it's in the money. They'll either, one, hold it till it expires and lose everything, which that's what happens, or two, they would post about it, or they wouldn't take profits, and then it goes down, and then post about it. And then that trains them, okay, well, next time I'm profitable, I'm going to sell it and take profits. Well, then what happens if it's not profitable? Then they'll just hold it till it's a loss. That math doesn't work out on a portfolio. Overall, you'll be red. So if we're supposed to be cutting interest rates, because Powell literally gives you a cheat sheet. He tells you when they were going to hike rates. He told you when they were hiking rates, and he's telling you now when they're going to cut rates, right? He's kind of hinting at it, but he's not exactly telling you. It's going to price it in, right? The second he says it, when they're going to cut rates, it's going to price it in before it happens. It's going to run. Just like in COVID, everyone was confused why we started going up. Well, supply chains aren't going to be down forever, right? They're going to open up, so the stocks are going to price that in before it happens. They're not going to wait until it happens. So the market isn't a scam and it's not rigged. You just don't understand it. Whoever says that, they don't understand it. They don't understand how the market works. So they're going to say stuff like that. So intelligent trade, in my opinion, would be January 2026 if I wanted to take a call on this, or when they cut interest rates. Just using this as an example. I'm not saying to do this, right? Do I want to throw my entire portfolio in these, which looks like they have a bad spread because they're more? They're not really 131 bucks. What, volume 0? There you go. I don't know what the last trade was at anyways. That's not important right now. So what is a debit spread? First off, let's just assume we're going to buy a call here. I'm risking all my money, all of it, right? I do have enough money to be in this until 2026. So Rocket Mortgage running flat lowers my probability. That's something that's going against this trade. Rocket Mortgage running down is something that goes against this trade, and so is time, if it doesn't do it in time. Right, so I can eliminate a lot of the direction in the theta decay. The theta decay is the biggest killer here. It's the biggest killer, and I can eliminate that through a debit spread. Let's go ahead, and that's where we'll switch over to the sell side here, and we can now sell a further out one. So in a debit spread, you buy the one closer to the money. What's the money? The money is the price of Rocket Mortgage, which is right here, $9. You can see it right here as well. Okay, so you would buy the closer on one closer to the money, and you would sell the one further out, any contract further out. The wider you go, the more risk you have, right? Max loss, and more theta decay because this is further away, but also more reward. Max loss is $109. Max gain is 300 and almost 400. If we sell closer to the money, my max loss is only 57, but I only win 143. If I sell way out of the money, my max loss is 115. My max profit is 885, but I'm also exposed to more theta decay. How? Well, this one right here that we bought rots. The price of the contracts rot the closer we get to this date. When we sell over here, if these get destroyed by theta, that money comes back to me. It's opposite of buying. When I buy a contract, an options contract, I am exposed. I'm theta negative, meaning that I lose money to theta decay. When I sell an options contract, it's all the opposite, meaning that I profit from theta decay. Okay, when I buy a call, I want the stock to go up. When I sell a call, I want the stock to go down. That would be if it's a covered call. And I don't want to confuse you guys too much here. So how do I make money? If this contract loses money when Rocket Mortgage goes up, but this one gains money. That's kind of confusing, right? Well, that's where delta comes in. In layman's term, delta is a measurement of how fast the contract is going to gain value versus the price. The delta is lower here and higher here. So we can think of it this way. If Rocket Mortgage starts to shoot up, for every $5 I gain, since we're way out of the money, $5 on a $10 stock, for every $5 this gains, this may lose $1, right? But I'm also hedged. I can make it safer where I sell this one instead, $2 out of the money. So for every $3 I gain, I'm shooting from the hip on the price. On the buy side, I'm losing maybe $1 on the sell side, but I have a max. My loss is capped at $57, and so is my profit. That's the downside of debit spreads. Is your gain is capped, right? We can also go wide though. I really wouldn't want to do 17s. That's way out of the money. I like the 10s and the 15s, right? You're getting about $400 profit, and your max loss is around 109 bucks. This is going to cost you $144 to be in this until 2026. Now, that doesn't mean that I'm going to lose all this money, because let's say Rocket Mortgage goes up just a little bit, and we're coming close to this expiration. That doesn't mean I'm at a max loss. That's if it were to, I were to hold this till expiration. And I can also get out of this whenever I want. I could get out of this for, let's say Rocket Mortgage just stays at this price till then. I may be down 20 bucks. So I was wrong and I lost 20 bucks versus people that learn and they're not doing, when they learn swing trading options and they're only on the buy side and they lose everything. Well, you can't learn anymore because your money ran out. I can still learn if I still have my hand in the pot here because there's something left to sell. And this really comes into play here if we're trading something like Tesla, because the theta decay is just unbelievable. Let's look at how bad this is. Let's say I believe Tesla's going to go up because it's down right now, and I wanted to buy for a month out. This is just under a month out. We're going to go down to the price of Tesla. This is here we go. So we're looking at $1,300 for a contract just a month out. Let's say I wanted to be in this for pretty much 2 years. Let's just say a year. We're going to choose 2025. And I believe, right, let's just say I believe Tesla is going to go up. I could buy a 290 call. I'm just choosing something random, and sell a 300. Let's choose something else here. We'll choose a 240 call at the money, and then I can sell a 250 call for $600. So it's about half the price for what? Quintuple the time. The other one for a month out was $1,300, $1,200 to $1,300. For half that price, I can have my hand in Tesla till 2025. So this increases my probability of winning. This also decreases the theta by a ton, by a whole lot. So let's choose something a little bit closer in here. Let's just say I want to be in it for a little bit. These aren't priced bad, not at all. So for about a month out, I can be in this for 80 cents, for 80 bucks versus 1,300. And I've eliminated most of the theta here. A lot of it, since this is such a tight spread. My max loss is 70. My max profit is 97. Not that good. But while you're learning and you're testing strategies, because you have to have a strategy. There needs to be a strategy that's profitable, that's proven to work, at least above 70%, 65 to 70%. If you're going in naked, you have a couple trades and your entire portfolio is going to be gone. Also, the emotion with how badly your portfolio gets hit when you're naked, meaning you're only on the buy side, you just have a call or a put, is going to rock you emotionally to the point to where the second you're green, you're going to sell it. And the second you're red, you're freaking out and then you're averaging down. That's like way too much for a new trader to handle, especially when you don't know what you're doing at all. Debit spreads are the answer. So again, we can also leave ourselves open to more risk, but also more profit. This would cost $270 instead of $1,300 for a month out, or $500. Max gain is 400 to lose 200. That's too wide in my opinion. But yeah, so debit spreads are the answer to new traders blowing their entire portfolios. Now, I had a guy, he takes big positions. Big positions, earnings, swing trading, short-term stuff. And he hits big just as much as he loses. But overall, I think he loses. He's always in my direct messages sending me his plays where he has 100 contracts or this or that. Well, if we just look at probability here, this is a game of probability. It is not, it can be gambling, depending on who you are as a trader. And it can just be a game of probability where the odds are in your favor. And I can also skew plays, which will be a more advanced video that we can do, to where it's literally risk-free. I can end up with it being risk-free down the road, which I can describe. I can show you guys how I did that with GDX, Gold Miners ETF. But if we just look at, let's just say in NVIDIA, right? Let's say something cheap. Let's say Apple. We'll just use Apple, okay, as an example. Overall, where does Apple go? It goes up. Out of how many years do you think Apple went down? 2008, 2009, it started to go back up. 2012, it went down. 2015, it went down. 2018, it went up and down. I don't know if we're going to count that. 2022. So I'd say maybe 4 years out of 23, Apple went down. So that probability is kind of in my favor if I'm playing calls right. But you new guys, again, you guys will buy a short-term expiration. So if we buy a call for a year out, it's $2,200 though, which is a lot. Could that work if I'm buying, let's say in September, that's historically a bearish year? Yeah, it could, but I'm also forking $2,200 out there, and then to average down, it's going to cost a ton of money. And then I can't trim and sell multiple contracts. So I'm using another example in this video, guys. I could buy a debit spread. It cost me $260. So I could end up buying I can buy almost 10 of these. Let's say I could buy 8. So I can sell the debit spreads as it's going higher and take profits back. Right? That's very tight. That's almost too tight. I kind of like this one instead. I'd rather buy 2 of these for more than half the price, the cost that it would cost of one, and be hedged on the sell side. Max loss is a lot here. Let's go ahead and switch this up. We can do something else with this. 2 10s, 2 15s. We can also do the 2 20s. Right, there we go. 388 versus 600. That's not bad. It's better generally, it's better to go closer to the money. I'm trying to see which one I can do here that's good. This one isn't good. The one I had before was better. Either way, I can be an Apple till 2025 for 1/4 the cost that it would cost of a naked call. And it's a game of probability. So if Apple only goes up, like I showed you on this chart here, this is a Robinhood chart. So we could pull it up on a more advanced chart, but that'll be, we don't have time for that right now. But if Apple only goes up, why would I trade a weekly or a monthly? I want to catch that probability with a long-term contract here. And the way I can do that is with debit spreads, and I can eliminate theta, and I can eliminate a lot of the time due to the debit spread, and the fact that it can run flat If you guys like this video, like and follow for more.